Two people. Same $50,000, same 20 years. One buys a rental property, one invests in index funds. 20 years later, both have over $500,000. But one worked twice as hard, took on 5 times the risk, and spent hundreds of weekends dealing with problems they never saw coming. Here's the problem with every real estate versus stocks video you've watched. The real estate guy only talks about cash flow. The index fund guy only talks about compounding. Neither is lying, but both are leaving out the parts that make their argument look bad. This video runs every number honestly. The ones people show you on thumbnails, and the ones they bury in the footnotes. If you want honest breakdowns like this, hit subscribe. No agenda, no course to sell. Let's meet our two investors. Alex and Jordan are both 30. Same salary, same city, same $50,000 in savings. Alex uses it as a 20% down payment on a $250,000 rental property, 3-bedroom house, decent neighborhood. 30-year mortgage at 7%. Monthly payment, about $1,030. Tenant pays $1,800 a month. On paper, that's $470 in monthly cash flow before expenses. Jordan takes the same $50,000, puts it all into a total stock market index fund, sets up a $300 monthly automatic contribution, and doesn't look at it again. Here's the first thing these debates never talk about. The psychological experience of these two investments could not be more different. Alex's investment is visible, tangible, impressive at parties. Jordan's is invisible, abstract, boring as hell. And feelings, as we'll see, are expensive. Alex's $470 monthly cash flow looks great on paper. Here's what actually happens. Property taxes, $250 a month. Insurance, $100. Maintenance, $150. Property management, $144. That's 8% of rent. Vacancy, $90 a month. That's 1 month vacant per year averaged out. That $470 just became negative. Alex is now losing money every month. Not a lot, maybe $2K to $3K out of pocket annually. But the passive income dream is gone. Meanwhile, Jordan's index fund averages 8% annual returns. In year 1, that's $4,000 in growth. No effort, no phone calls, no broken water heaters. Here's what real estate videos skip. The down payment isn't your only upfront cost. Closing costs, $5,000 to $7,500. Immediate repairs before the first tenant moves in, $3,000 to $5,000. That's $8,000 to $12,000, gone before a single rent check clears. Then there's leverage. Alex's $50,000 is controlling a $250,000 asset. That's 5.1 leverage. If the property goes up 3% in value, that's $7,500 in appreciation on a $50,000 investment, a 15% return on paper. Leverage is why real estate can outperform stocks. But leverage cuts both ways. If the property drops 10%, Alex loses $25,000 in equity, half the down payment. Jordan's index fund drops 10%, that's $5,000. Same percentage, very different pain. By year 5, the property has appreciated. Rents have gone up. Alex raises rent to $2,000. Cash flow is now slightly positive, maybe $200 a month after all expenses. But here's what that $200 costs. 2 a.m. phone calls about broken heaters. 1 eviction. 1 month vacant between tenants. 3 weekends of painting and repairs. Jordan's portfolio is now worth about $95,000. The $300 monthly contributions and 8% average growth have been quietly compounding. No phone calls, no weekends. By year 10, Alex's property is worth about $335,000. The mortgage balance is down to $165,000 in equity, $170,000, plus $24,000 in total cash flow over 10 years. But about $15,000 of that went to expenses. Net positive, $9,000 over a decade. Jordan's portfolio, $140,000, about $15,000 less than Alex's total. Real estate is winning. For now, year 20. Property value, $452,000. Mortgage paid down to $120,000, equity, $332,000. Total cash flow over 20 years after all expenses, about $40,000. Alex's total, roughly $372,000. Jordan's portfolio, With the same $50,000 start and $300 monthly contributions at 8% average return. About 550,000. Wait, what? Yeah, here's what happened. Jordan's $300 monthly contribution, compounded at 8% over 20 years, added $180,000 in growth on top of the initial investment. The stock market's compounding is quiet and invisible, but it's relentless. Real estate still has one card to play. If Alex also added $300 a month, buying more properties, reinvesting cash flow, the numbers would shift. But that requires more capital, more risk, more work. Jordan just clicked auto invest and went to bed. Stocks aren't immune to reality. Jordan lived through 2008. Portfolio dropped 40% in a year, dropped 30% in a month during COVID. The difference is Jordan didn't have to do anything. No tenants stopped paying. No properties needed emergency repairs. The portfolio recovered on its own. But the emotional cost is real. Watching $200,000 become $120,000 overnight is terrifying. Most people panic sell at the bottom. That's the hidden cost of stocks, not financial, but psychological. So, who wins? It depends on what you're optimizing for. If you want maximum wealth with minimum effort, stocks. The compounding is unbeatable, the risk is lower, and you can't get a phone call at 2 a.m. about a broken pipe. If you want control and forced savings, real estate. You can improve a property's value with your own hands. You can force appreciation, and the leverage, when it works, is powerful. But here's what I'd actually do, and I'm figuring this out as I go. Both. Start with index funds while you learn real estate. Buy your first